What's up everybody, GenExDividendInvestor here. In this video I'm going to analyze the subscriber's dividend portfolio that was sent to me asking for my feedback. I'm going to follow Tinder's lead and swipe right if I like their portfolio more than I dislike it, or left otherwise. Swiping right doesn't mean you like the portfolio more than your own, it just means you'd be willing to go on a date with it. If you value videos like this, then please hit the thumbs up button, subscribe if you haven't yet, and click that bell notification. Thanks, I really appreciate you hitting the thumbs up button. Finally, I'm not a professional wealth manager, so don't take anything I say as financial advice. I'm just someone who's passionate about dividend investing, and I'm grateful for how it's enabled me to retire in my 40s, and I hope to teach others about how amazing and literally life-changing it can be. I plan to run a poll on the community tab of my YouTube channel so that you can vote on if you like or dislike this portfolio. That way we can see how everyone feels about it, not just me. In my last portfolio review, which I did a while ago, I swiped the portfolio to the left, which means I wouldn't date it, and then 371 of you voted on my community tab and 76% of you agreed with me that the portfolio wasn't hot enough for you to date, so I agreed with the majority. I stopped doing my subscriber portfolio Tinder videos months ago, as I've been having fun doing other ones, but a Patreon aristocrat member of mine named Kurz asked for my feedback and he okayed me sharing his spreadsheet info, so here you go Kurz. By the way, leave me a comment down below if you'd like me to do more portfolio Tinder videos like this, and or tell me what your favorite types of videos are that I do. Also, feel free to email me your dividend portfolio for me to potentially review. You can find my email by clicking on the About tab on my channel, and then clicking the View Email Address button. The more details you share about your portfolio and yourself, like your goals, career, retiring timeline, investing experience, and whatever, will be helpful for me and others. I have a bunch of people who've submitted portfolios for me to review, and when I do these I don't pick them based on the order they were submitted, but instead based on how interesting they are, or if they're my Patreons or something. Okay, let's go over to Kurz's portfolio. First, a little bit about him. He told me that he's 38 years old, he works as an insurance broker. Kurz said he invested a little bit here and there, mostly in crypto. And he said he didn't get serious or start investing for real in dividend stocks until after COVID hit and he came across my YouTube channel. We see that he has 26 stocks in his dividend portfolio, which is worth around 30 grand right now, which is sorted based on market value of each position. So his largest position is his first, and that's Apple, one of the best technology companies in the world, and is one I'm logged in as well. He has 32.5 shares of Apple, which is about 5 grand worth, and thus is about 16% of his portfolio. I normally try to keep my largest position to be less than 10% of my portfolio, as I want to minimize any single stock from having too much downside leverage. However, that's just a guideline and not a rule for me, and I think it's fine for him to be at 16%, especially for being such a strong company I believe in. That being said, let's say that Apple made some new amazing product, like a revolutionary electric vehicle, and then the stock 4x from here, and it became 30% of my portfolio. Would I sell some? Probably not, because I believe in Apple so much, but it would be something I'd evaluate. There are risks and benefits from owning higher concentrations of stock, and as you get older I find myself tending to want to minimize downside more than just shooting for more upside, which is part of the reason that dividend investing resonates with me so much. My dividend income tends to trend up, almost regardless of what the market does, so my income downside is somewhat protected. Looking at his unrealized gains column, we see that Apple has some great gains for him at around 18%, and is second only to Raytheon Technologies in terms of his best overall gains since he started his portfolio. It looks like his Raytheon has had around a 23% return for him. By the way, Kurz is using an older version of my spreadsheet. In my newer one I've added another column called Total Returns, which is your stock appreciation unrealized gains combined with all the dividends you've received to date. I also added a total returns percentage column. In this older version we see that his ticker and his average cost per share both highlight in green if the stock's current price is below his average share price, as a way to draw your attention to it. In my new version I kept the average cost per share column highlighting in green still, but I changed the ticker to highlight based on payout date, as now that I'm living on my dividends I've found that payouts are something I like to draw my attention to. After Apple he has another great company in Disney, which suspended their dividend when the pandemic hit due to the parks and cruise line being impacted. But their new Mandalorian streaming series was awesome, and it acted as a catalyst for incredible growth for their Disney Plus streaming service. And thus their management team decided for now to continue to forego their dividend and instead drive that money into creating more incredible content so that they can really position themselves as a power player in the streaming wars. I love Star Wars and what they did with Mandalorian so much that we pay for a Disney Plus subscription at my house and I can't wait for all the new stuff they're working on. Then he has a great healthcare company in AbbVie, another I'm long in, and I won't reiterate the concerns about Humira, which might be overblown. Then he has JP Morgan Chase, my favorite financials company that I finally got into 5 months ago, and personally have already seen over 20% returns on them. pretty insane for 5 months, but it's even less than the 22% returns on Altria and 30% returns on Philip Morris I've had in those 5 months. I think JPM is one of the most solid financial dividend plays out there, though as we saw in 2008, financials can still be risky. Then he has AT&T, which came out with the unfortunate news that they're cutting their dividend, but also with the good news that they're spinning off Warner and merging it with Discovery, which I forecast will translate into good news from a longer-term financial aspect. I gave an extended reason why I'm still holding AT&T in my May questions and answers video, and I think that after their spin-off, AT&T will be an awesome pure play in the telecom space, so I continue to hold it as I like what I see in the medium and long term for them, though I also understand why some people walked away. After that he has J&J, which is one of my favorites in the healthcare space. Then he has a strong industrials company in Honeywell. Then he has another healthcare company I'm long in, which is Pfizer, which has been boosting its normal revenue growth rate due to the vaccines it's providing around the world. After that, he has a great networking company in Cisco. Then he has my favorite triple net lease real estate investment trust in Realty Income, which happens to be my wife's favorite company. Then he has Ford, which has been doing great for the last year or so, but has floundered for a couple decades, so I hope they can continue turning things around. I remember I had a Ford Taurus once and loved driving to work listening to Howard Stern on Sirius satellite radio. Baba Booey. Then he had a great company in Walmart, a company that has been effective at competing with Amazon and which has a safe dividend. Then he has Constellation Brands, which has some wines and beers and other alcoholic brands you'd recognize. They held up well through the pandemic and are doing some strategic changes to further their growth and have plans to enable some good shareholder returns through buybacks and dividends. Then he has one of my favorite utilities in Duke Energy, a solid play I own. Then he has a couple decent financial companies in US Bank and Wells Fargo. Then he's got a dividend ETF called WisdomTree's US High Dividend Fund, aka DHS. It has a fairly high expense ratio of 0.38%, but a nice distribution yield of 4.2%. One downside to DHS that I see is that the fund hasn't performed very well compared to SPY. Dividend Channel's total return drip calculator says that DHS has only had a 6.57% annualized return over the last 15 years, as compared to SPY, which has had a 10.84% annualized return over the same time period. After that, he has a good healthcare company in Merck, and then he has a powerful dividend king in Lowe's. Then he has another real estate play in Arbor Realty Trust, ticker ABR, a mortgage REIT. Oftentimes I see people get excited by high dividend yields that M-REITs have, but that sometimes comes at a cost, which is that their dividends tend not to be sustainable and consistent. It's not uncommon to see negative or no dividend growth with M-REITs, but in this case ABR has done a better job than many of its peers. 2008 was harsh for them, but since then they've been growing their earnings and revenue, and their dividend is well covered by cash, so they're one of the few mortgage REITs I think is worth looking deeper into. After that he has Walgreens Boots Alliance, which looks compelling to me at today's prices, if it can survive Amazon, which is a big if. Then we come to another strong industrials company in Raytheon. And then he has a classic financials company in Amex. Then he has Viatris, a pharma company which focuses on generic drugs that was created when Pfizer spun off its Upjohn business and combined it with Mylan. I personally sold my shares and converted them back into Pfizer, but I'm someone who likes to keep his positions tight rather than keep adding more, even if they're decent companies. I think it's too soon to tell if Viatris will be a great company or not, but it's reasonable to hold it. Then he has two super small positions in Starbucks and Target, both of which are great companies, so he probably has just started buying into them and over time will dollar cost average to get more shares. Let's look at some other aspects about Kurz's portfolio. He's making $768 in dividends a year, and I see a nice conservative average weighted portfolio yield of 2.51% and a great 3-year dividend CAGR of 8.57%. These bottom two lines estimate how his dividend income will grow year by year. The top line are growth estimates if he doesn't reinvest the dividends, and the bottom line represents if he does use a DRIP. So for example, his $768 in annual dividends could grow to around $4,000 a year without depositing another cent into his account, assuming his dividends actually grew by 8.57% for 20 years. Or if he had his DRIP on for 20 years and his 8.57% dividend CAGR held true for 20 years, then he could be making around $8,500 a year in dividends, which highlights how the power of compounding and reinvesting dividends really starts to snowball over time. If we look at the sectors he's in, we see a fairly good allocation. He has 19% in tech, 15% in communication services, 23% in healthcare, 14% in financials, and a smattering of others. It's helpful to look at the S&P 500 sector weighting if you're crafting your own portfolio. Then if we look at his dividend income by sector, we see healthcare is where he gets a third of his income, followed by others. If we look at his expected payouts to see how nicely distributed his income is, we see a quarterly pattern of $43 a month, $84 a month, and then $64 a month, and then it repeats that pattern. thus a decent pattern of income coming in every month. So what do I think overall? Well, I like what I see more than I dislike it, and so I'm swiping right. If I were you, I'd also consider investing in stocks like Amazon and Google. Of course, the most important thing here is not what I think, but instead that you're investing, and your desired path looks good, so congrats. Dividend investing is such an amazing life-changing journey, so keep it up, you have a nice portfolio going. Speaking of portfolios, I wanted to share some awesome news, which is that M1 has raised their referral bonus to $50 when new people open an account per their requirements. I'm not sure how long this will last, but if you don't have an M1 brokerage account, then the way it works is you click on my M1 referral link in the description of this video and then either open a brokerage account and fund it with $100 or open a retirement account and fund it with $500. Deposits which need to happen within 30 days of you opening the account. Then you need to keep your initial deposit inside the new account for 30 days from the date of deposit to get the free $50. It's basically free money, so consider starting that new growth or dividend portfolio that you've been thinking about. Finally, I highly recommend that everyone join my free Dividend Discord investing chat server, which has thousands of people on it and is growing all the time. And as always, please hit the thumbs up button, subscribe if you haven't yet, and click that bell notification. Thanks for watching and clicking the like button. Stay positive, and I'll talk to you again real soon. I am not a financial advisor, and these videos are for entertainment, inspiration, and educational purposes only. Investing of any kind involves risk. I am only sharing my opinion with no guarantee of gains or losses on investments.